People love tech stocks, but they're starting to look pricey. So today we're going to tell you about 3 cheap internet stocks according to one of tech's top analysts. So let's get started. This is Ticker Take.
John, our audience loves tech stocks, but they've gone up a lot.
Yeah, and that's why it's great to have Mark Mahaney on Ticker Take, Caroline. Mark is one of the best-known technology analysts and somebody who's great at evaluating both good companies and good valuations, which is key at this stage of the bull market.
Right, but before we get to Mark's stock picks, let's get his take on the current landscape.
Well, AI remains the dominant theme in the group. I mean, there's still, you still have to track secular adoption. You still want to, see how the consumer is faring, facing, because this is largely a consumer front end industry, not entirely, but largely. This is a sector that's had premium earnings growth kind of for the high quality, large cap names. It's kind of been north of 20%. That's premium versus the market at, call it 15%. Or low teens percent. So there are these checklist items, but if there's one theme, of course, it's AI. But not only at the infrastructure layer, but at the application layer too. And what I mean by that is it's not just how much CapEx spend do you get out of Amazon, Google, and Meta for their large language models, for building out AI tools and services and offerings. That's at the infrastructure level. It's at the application layer, which is, are these companies deploying AI to materially improve their products, their offerings, their services? Try to be really specific about it. Meta, over the last couple of years, I think has done a phenomenal job of using AI to increase both engagement amongst their consumers. They've used AI to make the content on Meta, on Facebook, on Instagram, more relevant to people, and it showed up in people spending more time with Meta, and Meta can monetize that through advertising. They're good at that sort of thing. But they've also used it to better improve their offerings to their other customers, which are advertisers. And they've used it to make sure that ads become more relevant too, not just the content, but the ads too. The ad campaigns have got a higher return on advertising spend, ROAS. And anyway, so we've seen this, but what the market wants to see in 2026 are more examples of ROAI, return on all that AI spend. Are companies like Amazon, or companies like Booking.com, or companies like Duolingo, companies like Zillow, are they able to use AI to better improve their offerings? And that's what the market's going to be looking for. We think we're going to get more of those data points as we go through the year. We've already seen some, in 20 and 25. We think we'll see more in 26. But that'll be key to how the sector trades this next year. It's the single most important theme.
And before we get to Mark's stock picks, here's how he thinks about finding a cheap tech stock.
Well, you just look at the company's fundamentals. It's the financials. You either look at that top line to see whether companies deploying AI can sustain premium revenue growth, 15, 20% plus, or they've got metrics, if they disclose them, like number of active customers, number of daily average users, number of monthly average users, whether those are inflecting up or not. You look for top line benefits from the deployment that, hopefully improves these offerings. And then you can also look at the bottom line too, like this, that create cost efficiencies, maybe allows these companies to continue growing, but with slightly less need to hire as aggressively as they have in the past. So it shows up in higher margins. And I know there's a lot of noise in these metrics and these financials, John. I realize there's a lot of drivers here, but AI is almost certainly one of those drivers. And so one of the things we track is revenue per employee. It's really simple. But we've seen this the last 2 to 3 years, a real inflection up and acceleration in revenue per employee. There are a lot of factors that go into that, but almost certainly one is the deployment of AI to make products and the offerings better, which creates more monetization opportunities. So anyway, that's sort of what we're looking for. It's kind of the simple headline P&L numbers, and we expect them to kind of, this is one of those difficult things to do, but if you hadn't had AI, would the growth rates be lower? Would the margins be lower? And that's what you're really kind of trying to intellectually test.
Okay, with all that said, let's get to Mark's top 3 internet stock picks for 2026. But first, a friendly reminder, this is not financial advice. Stock number 1, Amazon.
a popular pick on Ticker Tag and a popular pick on Wall Street. Let's get Mark on Amazon.
Our topic is Amazon. 335 price target implies pretty hefty upside from current levels. We think the stock's going to outperform because one, we believe that the cloud business, AWS, Amazon Web Services, that growth, which accelerated last quarter, will continue to accelerate for a good part of 2026, largely because of an inflection up in industry demand, but also material improvement in Amazon's offering. And then they've been able to solve some of the supply issues that kind of dented their growth last year. In the meantime, I think the retail business may well actually show acceleration this year. You've got some retail stimulus in North America and the US that'll help. But I really like this application called Rufus that they've been rolling out in a retail, in a retail offering, Amazon.com, that we all use, almost on a daily basis. And I think you have found a materially improved service that gives you more personalized recommendations. I really like some of these new features they've rolled out. Advertising revenue, I think, will continue to grow in line with or better than the overall company growth rate. So I actually think you have a setup here for accelerating revenue growth in 26 for Amazon with expanding margins. And I don't think that's reflected in valuation. So that's why it's our top pick.
Stock number 2, Expedia.
Everybody knows Expedia. It doesn't come up that much as a pick on Ticker Take. So let's hear from Mark.
There's 3 ways to play online travel. One is Expedia, one is Booking, one is Airbnb. Expedia has always been the kind of the ugly sister. Is that the expression? Like, it's the weakest of the assets. Why is that? It's had the lowest growth rate of the 3 major OTAs, on top line, and it's had the lowest margins. You've also had like 5 different CEOs in the space of the last 5 years. Maybe it's 6 years, but we've had a lot of management turnover there. And, but I think the setup now is different. And why I like it is that you've had a new management team now in place for 12 to 18 months, the CFO and the CEO. And I just think we've had an upgrade in management capabilities and it's starting to show in the metrics. And this is still significantly cheaper than Booking.com and Airbnb. And I think it has the chance to actually grow faster than those 2 assets this year in 2026 that are very well positioned to a couple of events like the World Cup, which is going to be based in the U.S., and which will probably lead to very healthy results for the U.S. hotel industry. And Expedia is a great derivative play off that. So I like Expedia. It's kind of a management turnaround story with very good valuation, very attractive valuation, and metrics and financials that are inflecting up. So Expedia is a number 2 pick.
And stock number 3, DoorDash.
Yeah, this is a company, in Mark's view, that has made some really smart strategic moves and investments, but hasn't been fully rewarded. So let's get his take.
We'll wrap up with DoorDash. It's our number 3 pick in large cap. This stock corrected a little over 20% late in 25 over investment cycle concerns. The company somewhat surprised the market by announcing that they were going to be investing aggressively into assets like Deliveroo, the delivery service that they acquired in Europe. They're also going to be investing aggressively into their tech platform. They've got 3 different assets they're trying to put all on the same tech platform. And they're also investing in things like new software, automation, and potentially robotic delivery of food or groceries. So there's a lot of investments, and that sort of panicked the market. I understand the market reaction to investment cycles. The good news is, hey, the investment cycle has already been announced, so that negative catalyst is out of the way. And this is a high quality asset, very good management team, world leader in the delivery business, and one that showed really nice diversification away from the U.S. to international markets organically and through acquisitions, and also away from just U.S. restaurant delivery to different verticals like convenience delivery, like grocery delivery. A survey work that we did last year actually indicated it's become the number 1 most popular service for grocery delivery in the U.S. So I think we just got a business that can sustain premium growth, 20% plus, which is hard to do. And there's very few large caps that are doing that. And I think they can generate margin expansion. So I want to take advantage of this recent correction in the stock. And we bumped it up to our number 3 pick for the year.
Thanks for watching here on the BNN Bloomberg YouTube channel.
TickerTech has its own YouTube channel. You can check it out in the description.
See you next time.